Right, hello, and welcome to today's webinar, which is all about the stock ranks. My name is Ed Page Croft. I am the co-founder and CEO of Stockopedia.com. And this is going to be a very, very extensive subscriber-only event. And I'm going to be going very deep into the stock ranks, which are one of the key features on the website and that we've had a lot of success with. So a lot of the material you're going to see today in this presentation will be part of a book I'm working on. And this is really a sort of a preview of quite a lot of the ideas that I'm going to be covering in a lot more depth in prose. I have not actually done a dry run of this webinar, so it is going to be of uncertain length. I imagine it will be 90 minutes. And I appreciate this is the middle of the day for a lot of people and maybe the middle of a work day. And if you do have to go and do other things, please understand that we will be recording this webinar and it will be replayed. Who is this for? This is for subscribers. And I appreciate there's a lot of different types of subscribers in the mix. So some of you I will know personally, some of you have been with us for many, many years. And some of you have been using the stock ranks since the beginning. 5 years ago. And so some of this material for you will have seen before, but I go a lot deeper into a lot of the concepts. I'm going a lot deeper into the performance histories and a whole range of different ideas. For those of you who are new to the site, I will be giving you a complete onboarding into understanding the principles behind the stock ranks and how to use them effectively and what will possibly catch you out if you are not aware. So let me crack straight on. You don't really want to see any more of me. And now I have to figure out how to share my screen, which is this one. So I'm now sharing my screen and I'm going to go to full screen. Hang on a minute. So this is the presentation, Stock Ranks, which is about harnessing the power of factor investing for stock market gains. And this is a very important principle. Before we get started, I just wanted to give a quick disclaimer. There will be a lot of material in here. It's very much educational. And this is all for DIY and individual investors. There will be a lot of historic data and historic performance records. And of course, past performance is not necessarily an indicator of future returns. And as we know, stock markets are very, very volatile. And anyway, I just wanted to make it clear, this is for people to make their own decisions on stocks. Don't take this as investment advice. This is very much investment education. In this webinar, I'll be going over a few key things. Firstly, an extensive introduction and deep dive into the stock ranks. I'll be talking about factor investing, what that is. I'll be talking about the 3 factors behind the stock ranks and explaining the other rankings on the site. And if you don't know what a stock rank is, we'll start right here. Then I'll be giving you the 5-year stock rank performance history. So for those of you that don't know, we first published the stock ranks 5 years ago at the end of April. So it's just over 5 years and we have a terrific history. And we've been launching different regions from our base in the UK. We've been extending our coverage to Europe, America, Canada, Asia, Australia, etc. And this is, so we have now extensive history. And I'd like to go deep into this, talk about the returns to the stock ranks, talk about the win rates and hit rates of finding winners with the stock ranks over this period, as well as their performance in sectors, size groups, and across all these regions. Then also, once I got through that, I'd like to talk a little bit about the style classifications, which are based upon the different combinations of stock rank. And this is a very, very useful lens for building a portfolio and coming up with your own strategy. After all this is through, and there are a lot of slides to get through, we'll be going to a usage guide to the site. And this will be going deep into all the features and quirks of the site that you might and might not be aware of, and will be very, very useful for new subscribers especially, but you might even pick up some tips and tricks if you're a tenured subscriber. At the end, I will be doing Q&A, and that's it. We'll crack straight on. Okay, so introduction to the stock ranks. What is the stock rank? Starting it absolutely in basics. I'm going to give you a quick exec summary of what this is. And if you are a tenured subscriber, you can spend 10 minutes twiddling your thumbs. Every stock in the market, we rank against all the others for 3 proven historical drivers of return. quality, value, momentum. And they're all ranked as percentiles between 0 and 100. So the best ranking for any share would be 90 plus or 99. And the overall stock rank is a composite of those three, equal weighted, which then is re-ranked as a percentage score again. So the quick rule of thumb is to understand that if you're looking at a 90 plus ranked share, it's in the top 10% of the market for that factor. Now, a lot of what I'll be doing in this presentation is going deep into each of these factors and why they're important. So in essence, if you're looking at a stock rank on the site, it will be anywhere between 0 and 100. Stocks that are ranked 0 can be thought of as sort of expensive, weak, junky shares, whereas stocks at 100 can be thought of as good, cheap, and strong across that quality, value, and momentum lens. So that's pretty simple to understand. I'm sure everyone has spotted these already on the stock reports. They're right here in the top right of the site. Quality, value, momentum, and the stock rank. So very easy to see. And also in, so you can see here, here's this one is actually Tesla, and you can see they rank from high to low. If you want to go and find all the stocks from the top down, you can click that link at the top of the site that says ranks. And that's quite important to know. So how have they performed? Well, this is actually our core 5-year UK history on an annualized basis. And on this axis from the left to the right, it goes up in buckets of stock rank in 10 of each segment, as you can see here. And so you've got increasing stock rank on this axis, and the very top 90 plus set of stocks has returned almost 20% annualized, which has been an extremely good return. It is worth obviously pointing out that this has been a positive period for the stock market as a whole, and there haven't been any particularly heavy declines during that period. There have been 10% declines during that period, but the market has generally bounced back. But as you can see, there is this general trend towards higher performance in higher ranking shares and poor performance in lower ranking shares. So as a rule of thumb, higher ranking shares have outperformed. Will they outperform in the future? That's up to you to decide. There have been many, many subscribers who've told me just how fantastic the stock ranks have been for their own portfolio performance. Some of the people on this page I know personally, and it's been really great to have such a close relationship with subscribers over the years. And the feedback coming back now is about sort of a lot of the kind of, really actually quite dramatic effects that these sorts of tools on the site have had on people's financial well-being, enabling people to sort of bring retirement forwards, et cetera, et cetera. And you can go and on the discussion part of the site, obviously you can go and talk to people who are very, very experienced of using these. Some such as Phil Hoffer, Ian Wright in particular have been, real champions for these on the site in the commenting section. Anyways, what I want to do now is go and give you a background on factor investing. Don't let those words frighten you. This is very, very straightforward because this is really the inspiration for the stock ranks. And I mean, if I could just say, this is very much based on the desire to create the stock ranks is very much based on my own experience in stock markets and me having a pretty bad time in the financial crisis in 2008. And then hunting and searching for solutions for better ways to invest going forwards. And I uncovered this emerging science of factor investing, which has really become a thing over the last 5 years, actually, and really accelerated since we launched the stock ranks. And having dived into masses of academic research and literature on the subject, we designed the stock ranks. And but it's really based on this idea of factor investing. So factors essentially are quantifiable traits that may explain stock returns. You can create a factor from a simple financial ratio like the PE ratio or the dividend yield, but anything you can quantify can be analyzed as a factor. But to really be valid and validated as a persistent factor, it has to be persistent across the decade. So there must be it must explain performance on the upside and downside over significant periods of time. It should be pervasive, so it should work across sectors and regions. It should also be intuitive and easily understood, and it should be investable. So there are many factors that have been found by academic researchers, but as soon as they publish a paper, the factor disappears. Why? Because institutional investors or hedge funds will go and basically arbitrage it away. So they'll go and it will disappear. So the factors that we're talking about today are really the most persistent and pervasive factors there are in the market, because they haven't disappeared. Now, if you can think of like what drives stock returns, there are several really different real inputs on that. Obviously, there is the company's specific reason why a stock may go up or down. And that is a very big part of a stock's returns. But then there are these factors, quantifiable factors, that I've grouped into major buckets. You can obviously think of the whole stock market as a tide that lifts and rises, or falls and lifts all boats, or sinks all boats at different times. And these other factors are just like that. Quality, which is the idea of profitable shares beating junk shares. Value, which is cheap shares beating expensive shares. Momentum, which is winners versus losers. Volatility, which is low risk shares that beat high risk shares. And size, which is that small caps beat large caps. And this set of different factors actually we've designed it to map them to different features on the Stockopedia site. And this is how we really, really help across these, especially these 5 factors. The company-specific factors is obviously down to one's own research into company-specific traits and understanding individual companies. The market as a whole, obviously, it goes up, it goes down. But these 3 are the most important for the stock ranks: quality, value, and momentum. But we also do analyze the volatility using the risk rating, which I'll explain briefly later, as well as size, which is available in size groups and using different size metrics on the site. So I hope that gives a quick map for the most important factors that drive stock returns and how they map to features on the Stockopedia site. Now, if I was to take a single stock's return, and I think this is very important to understand especially for private investors who often don't have as much education on the markets as more sort of professional investors. But most people look at a stock and they'll look at a stock's annual return. Let's say a stock's made a 12% return in a year, and they'll think it's all down to the stock. So they'll look back and go, wow, I was clever, I bought that stock, aren't I brilliant, it's gone up 12%. But it's not really how it works. A lot of a stock's return can be broken down into these different factors. So I've broken this down into a kind of generic list of those factors we just talked about. And if you actually look at, for example, what the market's participation or drive on that stock's return, you can actually break this down into components which are driven by all of these different factors. And the actual company specific reason or the company specific risk and return is actually a much smaller, could be a smaller component of it. And this works both ways. So for example, a stock might have gone up less, but perhaps the reason it didn't go up as much is because of the company specific reason on the downside. And one of the really interesting things about when you build a portfolio is the more stocks you add into a portfolio, the more the company specific reasons why stocks go up and down is diversified away. So if I put both of these stocks together and their returns together, you can see that they might cancel each other out from the company specific reason. And you may just be left with the factors that are underlying in the market. Now, this is very important to understand, especially when you think about fund managers. The more that you add diversification into a portfolio, the more that the portfolio is driven by its factor exposure. And this has been studied many, many times by research analysts, quantitative analysts. And one of the most famous papers on that was by a guy called Mark Carhart, who wrote a paper called On the Persistence of Performance in Mutual Funds. And this quote I love from that paper. It says, while the popular press will continue to glamorize the best performing fund managers, the mundane explanation of strategy and costs account for almost all the important predictability in fund returns. Now, to create this paper, Mark Carhart, who is himself a fund manager now, but he was a professor of finance at the time. He actually went on to do quantitative research at Goldman Sachs, and then he founded his own firm. But to actually do this analysis, he analyzed all funds in the universe for their exposure to these factors. And he basically proved that there was almost none of their returns could be explained by skill, essentially. And this has been taken even further in a paper more recently called Buffett's Alpha. Now, everyone likes to think of Warren Buffett as the greatest stock picker of all time. I think of Warren Buffett as one of the most smart factor investors there ever were, who figured this out way before anybody else. In Buffett's Alpha, they essentially showed that Warren Buffett used two factors and leverage. He was focusing on quality shares that are also low volatility and geared it up with about 1.6 times leverage. And if you actually model that strategy, it would have done and explained almost entirely the performance of Berkshire Hathaway, which I find rather interesting. But the key point for to take away from this is that it's factors that drive stock returns across diversified portfolios. And as we'll see, they work incredibly well. So why do factors work? And this is the last slide on this section. But why would, for example, value outperform? If we think about cheap shares outperforming and expensive shares underperforming, well, the reason that cheap shares outperform is because there are really two reasons: risk or mispricing. On the risk side, you can think of buying these kinds of shares as you can get and earn an insurance premium for taking on the risks of those more financially risky shares. And that kind of premium that you pick up, you can think of like an insurance premium, but it is a sort of payoff for the potential of enduring bad times in the market. Because, for example, value investing underperforms in recessions, etc. So value investors have to take on that risk that they will have significant periods of underperformance. But it's also due to mispricings. And as I go through and look closer at the stock ranks, we'll understand that that a lot of the drivers, and personally, I think are the biggest drivers on why factors work, is due to pricing errors due to our own behavioral biases. So especially as private investors, we get really excited about some kinds of shares and they get overpriced, and we get really down on other types of shares and they get sold too low. So these are the kind of two main buckets as to why these factors work. And the other thing to understand about this factor investing idea is that it's nothing new. This timeline actually illustrates that way back in the 1920s, across quality, value, and momentum, different researchers and practitioners, such as Jesse Livermore or Benjamin Graham, were using these ideas of value, momentum, and quality to construct portfolios that would beat the market. But back then, it was very hard to prove it unless you said you had a strategy and that's what you were following, and it outperformed. And of course, some of these people outperformed amazingly, such as Warren Buffett. But in about 1990, what happened was that there were massive databases being built on the stock market and computer power was accelerating. And that's when academics started being able to really sort of compute and understand the returns across the cross-section of the stock market. And Nobel Prizes have been given to, for example, Eugene Farmer for the work on understanding and proving that these factors actually work. And the way you can think about this as a Stockopedia subscriber is that we are bringing this database and the computer power to deliver these factors in a very simple, consumable way to you to build your portfolios. And that's really how I like to think of it. And because it does take a huge amount of work. I have a big team and they are working on this stuff all the time. So anyway, I want to zoom in on the three factors behind the stock rank. And this next section is going to go a little bit deeper into what composes the quality, value, and momentum rank. I do like to use this Venn diagram because, and as you'll see, it's a very useful tool when we start talking about the combinations of ranks later. But essentially, you've got the idea that good quality, profitable shares beat junk shares, cheap shares beat expensive shares in value, and improving or strong stocks beat deteriorating stocks. And I'll be showing you some of the results in each of these sections. Let's go straight up into the value rank. So, cheap stocks outperform expensive stocks. How do you value a company? How do you know that a company is cheap? Okay, and I think there are several different lenses you can use. And you can there's two main ways of doing this. You can, and the way that we prefer to look at it is in terms of relative valuation. And that takes a financial ratio and compares that ratio, all the different companies in the market for that ratio. And we can look at doing this valuation against what a company earns what it owns or against other measures. And this is a very natural thing to do. So you might look at a price of something and you'd be thinking like how much of the asset you would get. And we might use the price to book ratio for that. If you might look at the price of an asset and look and think, how much do I get in terms of cash flow? How much do I get in terms of earnings, which is the PE ratio? And how much do I get in terms of dividends for that price I'm paying? So we can use all these different financial ratios or compare it, for example, against its sales if it doesn't have any earnings, and use these 6 different ratios in these different buckets to build a valuation. And the way that we do it and the way we create the value rank is we'll take a company's P ratio, for example, here, this one, 3.2, which is very, very low. And we will rank it. We'll sort the whole market from high P ratio to low P ratio. And we will calculate a percentage ranking for it. So this would show that this company's PE is cheaper than 94% of stocks in the market. And on the stock reports, you'll actually see these as traffic lights, these little meters. But let's imagine there was a higher P ratio and of 18, which might be an amber bar on the stock report. And it would show that this company is cheaper than 42% of stocks by the PE ratio. And on the last one, let's say a very high PE ratio that you might get in a really, really popular share, it would potentially have a much a small red bar, and you can see that it's got a smaller percentage ranking. And we will put these together one by one, looking at the 6 different financial ratios I just discussed. And we will add up all of those percentages, and then we will re-rank them into a percentage ranking from 0 to 100, where 100 is cheapest for every stock in the market. And that creates the value rank. It's important to understand the value rank is a complete measure of cheapness. Now, these are the actual results of 5 years of history of the value rank, from 0 on the left up to 100 on the right. And it's quite extraordinary when you look at this trend for up to higher performance on the cheaper shares and the cheapest bucket of shares. But you must understand that actually value especially is extremely noisy, and there tends to be a much wider dispersion of results amongst cheap shares, or these highest ranking cheap shares, and there's a higher chance of bankruptcy risk. So the returns are earned for earning that insurance premium, as I was saying earlier. Why does it work? Well, it's because of these 2 buckets, risk or mispricings. There's this payoff to owning riskier assets. Cheap stocks have a higher risk of bankruptcy. Cheap stocks may decline more in a recession. There may be those bad times you have to endure. And that's the reason why we're seeing this gradual rise towards cheaper stocks having higher returns. But also, there are mispricings in cheap stocks, which I think is a big contributor to this. Investors tend to be overly pessimistic about cheap stocks. And, if you see a cheap stock and it's got problems, you're probably unlikely to want to buy it. And it means there actually normally isn't enough buying in cheap shares. If there was enough buying in cheap shares, then that trend in performance that we saw on the previous slide would not exist. If people bought cheap shares more aggressively, the returns to cheap shares would be more normalized. And so the market has not been efficient in the UK, certainly, and a lot of international markets over the last 5 years for value. And also investors are very loss averse. So I'm sure that many here have seen that when you are holding a share and it's gone down, you have a reluctance to sell it. You've put a lot of research into it. You are absolutely convinced it's a good company. But when a stock falls, you don't like selling it, because you think that basically selling it is admitting that there's a mistake, or admitting, but a lot of people want to get back to even. So when companies actually do fall, there is actually a almost a lack of selling pressure to get it to its correct price. Anyways, the key takeaways to think about the value rank is that this is a pure measure of cheapness. There is no quality factored into the value rank. And that means that it is, I would say, of all the 3 rankings, the riskiest of them all. High value rank stocks are likely to have a higher chance of financial distress, and be very beware of very, very high value rank shares of 99 or 100, as they possibly may be value traps. And I'll talk to you a bit more about that in a mo. Use the value rank in combination with other factors. I can't stress this enough. If you are using the value rank in a strategy, make sure you couple it up with other measures of quality or momentum or other factors, so that you are picking a better bunch of those cheap shares. Moving on to the quality rank, which is obviously very important from a value perspective. Good stocks outperform junk stocks. That seems so blindingly obvious. Remember earlier I was talking about how good factors should be intuitive. And I think you can say this is very, very intuitive. If good stocks didn't outperform junk stocks, I think questions would be raised. But really, good stocks shouldn't outperform junk stocks, because if we recognize they're good, they should be on higher valuations. But anyway, this does exist. How do we assess quality? I like to look at it through this lens, and this is the lens that we compose the quality rank from. And we look at these three dimensions. Firstly, is it a good business? What's the quality of the franchise? If you can think of how Warren Buffett might look at a share, he'd want to see long-term evidence of strong profitability, long-term evidence of strong free cash flow, stable margins, stable growth, the kind of stalwart bellwethers that would be really worth owning for the long term. And he calls that the quality of a company's franchise, and I mirror it here. And this is one of a large component of the quality rank, possibly over 60% of the quality rank is composed from this measure. This does not look at current profitability, it looks at 5-year average profitability, and that's important to understand. The second part that we look at is the direction. Are fundamentals improving? So imagine you have a company that does have a good 5-year average profitability, but the fundamentals have dipped recently, but they're coming back, and they're coming back strong. And we use a measure called the F-score, the Piotrowski F-score, which is on every stock report, and it's labeled as the health trend. And this is one of the most powerful measures of assessing fundamental trends and fundamental health trends. And this is a heavy weighting in the quality rank. It's about 35%. And it's very important to understand that this acts also as a counterweight. There can be companies that have been suffering from recent declines in their potential profitability, but if they are returning, the F-score really picks them up. And I think this is a very important point about the quality rank, is that it has a much broader assessment of quality than what I take of as naive measures of quality. So naive measures of quality are the kind of headline figures of profitability. And what we try and do is look at the academic research and make sure that we're focusing on metrics that are proven to have more outperformance. So, for example, gross profitability is a better measure of and predictor of future price performance than looking at profitability lower down the income statement. The last thing we look at is risk. So, is the company safe from risks? And so we try and rank to avoid high leverage companies, which have lots of debt. Trying to avoid high bankruptcy risk companies, and also companies that may be cooking the books. And we have two professors of finance called Edward Altman and Mesod Banesh, who created these two scores. And there is a big decrement added to companies that actually do suffer from these risks. And these all come together to be and build our quality rank. And as you can see, the performance of higher quality rank companies, higher profitability companies, higher cash flow companies has been much stronger. And it's been stronger than, and almost again in this sort of linear decline towards junk shares. And you can think of junk shares as the companies that don't have profits, that are, having negative, they have, bad cash flow, they have bad debt, they have bad liquidity, and they're just the kind of things you probably wouldn't want to own. Why does quality work? Now, again, looking at it through this lens of risk and mispricings as the two ideas around why factors work, nobody can figure out that there's any more risk associated with higher quality shares, because higher quality shares tend to be lower volatility. They also tend to hold up particularly well in bad markets. So you get a flight to quality whenever things are bad. So no academic research, they have tried to figure out why higher quality shares are riskier, but they can't figure it out. So the only reason why quality really should outperform is because investors are making errors, that investors possibly have preference for higher risk shares. And, there is this lottery effect in the stock market where, people who just love a gamble. So they will choose a stock which potentially could double in the next year over a share which is a more certain 15%er. So that's one of the reasons high quality shares sometimes are underbought. Also, investors focus too much on visible metrics such as EPS, earnings per share, or profits, rather than more hidden and predictive metrics, which could be cash flow or other measures of profitability. So, for example, accruals or other measures. And because these visible metrics are also more manipulated by management, they can often be less predictive. So I think these are the main reasons why investing in high quality shares does work. Obviously, one of the other great benefits of investing in high quality shares is they tend to be self-financing. You're more likely to own them for the long run. So you're more likely to own a high quality, high cash flow share over many years than you are, let's say, a cheap share which bounces back from the risk of bankruptcy. So in that term, I think in terms of building a portfolio, focusing on higher quality shares as some of the core of a portfolio is a very good idea. Once again, we designed the QualityRank to be predictive rather than descriptive. So it's weighted towards those academic factors like the F-score and gross profitability that are proven to work rather than more naive measures that don't. And it's also a broader definition of quality than most expect. So there is a heavy weighting towards this, the direction of fundamentals, which means that it can pick up turnaround and recovery stocks much more quickly than other measures that might focus on current profitability might. So it's actually very, very useful for in lots of different ways. Moving on to the MomentumRank. Now, this is really fun. This is the third prong of the overall stock rank. And the MomentumRank is, I personally love momentum. I think momentum is deeply, deeply misunderstood. Most people shy away from it. We're psychologically biased to look for bargains in the stock market. And the momentum in the stock market is often radically underpriced. Past winners continue to beat past losers. And I've always shown this case study, which gets better and better every year. David Stevenson, I know, and he's been a great backer of the site in the FT. He's written this up a few times. And he wrote once this, back in 2013, he wrote about stock screens to net the ones that got away. And I'll just read this out. One of my big regrets for 2012 was not having bought into a small UK-based transport group called Dark Group. Lots of quantitative and qualitative measures told me that the owner of the Jet2 airline, et cetera, was way too cheap. Yet sadly, I found more interesting stories to chase and I let it get away, only to watch in horror as the price more than doubled. Well, when David wrote this article back in 2013, the price was here at 150p. And as you can see, it had doubled between October and March. Who in their right mind would go and buy that share? Okay, most investors would react exactly like David Stevenson and not buy it. Of course, what happened since is this. It's now trading up near 850, which is a kind of extraordinary return. And it shows you that, that the only way that you can actually find shares that are going to, double, triple, quadruple, quintuple like this one has, is by buying shares that are at new highs. And I always try and coach everybody I know to get over this this fear of buying shares at new highs. The first guy that ever got me into and understanding momentum was Jim Slater, way back in the 90s when I started investing. And he focused on a measure called relative strength. And this is one of the most important factors in our momentum rank. And I want to explain that our momentum rank is split into two kinds of momentum: price momentum and earnings momentum. I'll talk about price momentum first. So thinking about that chart from David Stevenson, you can look at how is the price performing relative to the market over 6 months or a year or different time frames. And if a stock is radically outperforming, it's a positive signal. It's a positive signal that a trend has started that may persist. And that is a very predictive factor of future returns, especially over 6 months to a year. We call that relative strength. We also look at how close a price is to its 52-week high. So looking at the high price over the last 12 months, and we rank the stocks that are in their highest bucket more. We give them more weighting in the momentum rank, and we also look at whether stocks are trending with their more recent share price above their older share price. So this is an indicator of trend, and we use something called moving averages to do that. Now, these three factors give a very kind of robust, diversified measure of price momentum. But also we look at what is called earnings momentum. And there's a lot of proof that price momentum is completely explained by the trend in a company's earnings or profits. And they are very, very, very correlated. So what we've tried to do is not just focus on price in our momentum rank, but also to look at the potential momentum in the company's underlying core earnings. And the way we do this is by relying on analyst estimates. So you can think of analysts in the city, broker research comes out, they will go and put a projection on a share and they will say, hey, this share is going to go up, or the earnings are going to be X next year, and I'm predicting 10% growth. Now what happens is when the company comes around to release their results, they will either meet the market expectations, or they will beat the market expectations, or their profits will be under it. And this is called earnings surprise. And a positive earnings surprise is a very strong factor of earnings trend. So we use this in the momentum rank too. We also look at whether research analysts have upgraded their recommendations, for example, from sell to buy. We also look at whether research analysts have recently upgraded their profit forecasts or earnings estimates. So these are the different ideas that go into our momentum rank. And again, they come out with this score from 0 to 100. And the performance has been just stunning. The top 10% of shares ranked by momentum have returned 20% annualized over the last 5 years. And the bottom set have underperformed dramatically. Not quite as linear as we saw before. This 20 to 30 bucket seems to have done the worst. But I think it's pretty powerful, as you can see. And actually, very recently was the first time the momentum rank actually started outperforming the overall composite stock rank that I'll talk about in a moment. So anyway, why does momentum work? Well, people have struggled to come up with a kind of insurance premium reason for it, that there's a payoff to owning that momentum stocks may be riskier. But often momentum stocks do have larger growth opportunities and often riskier future cash flow streams. So you often find like stocks will get momentum, but that momentum is because of the forecasts. So that is potentially a risk and potentially one reason why momentum outperforms. There is also this idea that momentum has intermittent crashes, which, to be honest, only really is true when people are short momentum as well as long momentum. So for people which is the majority of subscribers who are long momentum, the risk of crashes is far, far, far lower. But it is worth bearing in mind that there can be more volatility in momentum shares. The other idea is this idea of mispricings. And I'm going to talk a little bit more about this because people make errors in momentum stocks. So in the short term, when there is a new trend, so a company beats their earnings, investors often underreact to these surprises. And that means that, when it pops up and it goes to a new high just after an earnings release, there is underbuying on that share. And that means that it starts its trend popping up, but it doesn't go high enough. But as the information starts percolating in the market and the stock starts trending up, it creates what's called a bandwagon effect, and investors will overreact to that trend and they'll push it too far. So you get this kind of underreaction on one side and overreaction on the other. And that's important to understand. You can think of this idea as like a frog in the pan, that the market reacts slowly to information that's released over time. We all know about this idea that if you put a frog in a pan, and if you boil it slowly, the frog won't jump out. It just sits there warming up and then eventually dies. I haven't actually tested this, but I like the story. And really, that's the reason why trends actually do persist in the stock market. But if, of course, you pop a frog in boiling water, it bounces straight out. So, and actually it has been shown that companies that have really dramatic news and release dramatic news get priced much more efficiently. So they actually are less likely to create trends. So that's quite an important idea. Now, if we bring all these ideas together, quality, value, momentum, into the stock rank, it's trying to make the best of all worlds. So you get good, cheap, improving stocks. And the idea is they beat their opposite, expensive, deteriorating junk. And the QVM stock rank is a equal weighted composite of these three rankings: quality, value, and momentum. And we put them all into and re-rank them into the overall stock rank. And there's lots of research on this. And I love this quote by Robert Novi Marks. Over time, tilts towards value, momentum, and profitability have outperformed the market. A combined portfolio of these three has provided a much higher reward and a significant reduction in extreme risk. And Novi Marks is again an academic who has now moved into asset management, or he actually advised on asset management. He writes fantastic papers all about these kind of factors. And very important to understand. Now, the stock rank performance here, again, I showed you this earlier, but as you can see, very, very strong. And I think we want to just spend a moment thinking about these psychological biases. I've talked about mispricings. I've talked about the reasons high stock rank shares outperform. And it's absolutely clear why. When you start thinking about the sentiment around the way that stocks trade. Now, I'm taking you back a few years here, back to 2015, when, and this always sticks in my mind because it was 1 week and two shares that had opposite stock ranks, both had opposite announcements. Dark Group that we talked about earlier had a stock rank of 100 at the time. I think it was the top ranked share on the site. And they released an announcement that was basically said they were meeting market expectations. It wasn't really even that much of it wasn't really that much of an upgrade. But on the announcement, it rose 18% on the day. And it was interesting because there was very little comments on the site. And there was one comment here that says, this seems a rather euphoric reaction considering the company is only saying it will match last year's numbers. I'd probably be tempted to bank some gains on today's big move up. A 77% rise over the next 12 months. And if we look at the opposite, a company called Cinity, it had a stock rank of 1. And I believe it had announced that it was doing a placing. It was going to raise more capital. And it was a placing at a discount. So the shares fell 35% on the day. And there was a flurry of 50 comments on the site. All these people that were holding it, and there were lots of comments, but I've only picked this one out. I still like the stock and will hold on. I had topped up around 130, but that might look okay this time next year. Well, the shares, as you can see, over the next year dropped dramatically, another 35% over 12 months. And there really is this psychological bias that I see again and again and again and again against buying higher ranking shares. And the reasons are that people don't like buying value shares because they might be problematic or ugly. People don't like buying profitable shares because they're a bit predictable. And when shares go to new highs, everyone thinks I've got to bank a gain. Whereas if you take the opposite, you take an exciting share with a kind of really binary future outcome like Cinity did. And even though it's like bleeding money and has no profits and it's investing for the future, people find it a lot more exciting. And as you can see, they tend to hold on. And I think these sorts of ideas are critical to understand in the stock market. And I've always found that, actually sometimes doing the opposite of what you instinctively want to is the best way to train yourself in better habits. And it starts with the mind. Now, taking this a little bit further, before I go into all the deep performance statistics on the site, I want to explain to you that we have a whole suite of stock ranks on the site, which isn't just these three basic ranks of quality, value, and momentum, but also some of these what I call crossover and composite ranks. There is also, for legacy reasons, a rank called the growth rank, which you can screen on and you can use and put into tables for those that like it. But it does not perform nearly as well as quality, value, and momentum. When we set out to create the stock ranks, when we actually, the first composite we actually published was the QVGM, and which included growth. But the more analysis I did, the more research we did into academically what works, the more we realized the growth rank was a less powerful factor and also fully explained by quality and momentum. So we dropped it and we created this much more transparent lens. And of course, by dropping it, I will show you later that this lens is still picking up the stock rank still picks out high growth shares. But in between each of these basic rankings, quality, value, and momentum, we have these other rankings. This one we call the QV rank, or the quality and value rank. And there's a quality and momentum rank and a VM rank, value momentum. And there is a QVGM rank for those that really, really want it. And I'll show you how to go and screen the market based on these ideas a little bit later and show you where they are on the site. One other thing to point out, I'm not going to go into depth on this. I've done a webinar on this before, and there's also an ebook on the site about this idea, is the risk rating. The risk rating is our 5 classification system for a company's volatility. And it goes from less volatile, low volatility shares, which are low risk shares, which are labeled conservative. Right under their stock quote, you will find this label. And they're rated from conservative through to highly speculative on this range. And if anybody is trying to use the volatility factor to build their portfolios or diversify their portfolios, the risk rating is fantastic for this. I use it all the time. And the one thing I would say is avoiding highly speculative shares is always a good idea. They are so super volatile, and they do underperform. We've actually found that lower volatility shares do actually outperform the market. Right, I've got a few brain tips. How to think about high stock rank stocks. Now, I've written an article about this in the past, and I've pulled out some key insights from it. And I really, really want people to understand these ideas. They're very important, and they can save people money. So firstly, a quote from Nicholas Nassim Taleb: never cross a river because it's on average 4 feet deep. If I said to you, oh yes, of course you can cross a river, it's 4 feet deep on average, and you walk across it, you're not going to be thanking me if you fall into a deep crevasse, which is like, 50 feet deep. Portfolios of stocks may have these return characteristics I'll be talking about over the long term, but individually, there is zero guarantee of outperformance in a specific stock. And you see a massive divergence, massive distribution of returns and outcomes in high-ranking shares. Just because a share has a 99 rank does not mean it's going to go up. It could collapse by 65%, like DX Group did. Probably is the worst one-day decline I've ever seen in a high-ranked share. But these outcomes do happen, and are to be expected using systems like this. So be very aware that there are lies, damn lies, and statistics, I think they say. But the averages are not the expectation for every single individual share. The other thing is, don't overweight precision. A 99 ranked share is really no different to a 91 ranked share. A small tweak in the algorithm could easily change the relative ranking of each. And I think that's an important point. These are, they are general buckets. I'd like to think of them more in terms of 10 ranked buckets. So a 90 plus is, in my view, a better prospect than a sub 10 ranking share. So don't overweight the precision. I see people often, and actually it's a good point, because I actually was analyzing 99 ranked shares, and they were slightly more risky and slightly more volatile than the sort of 80 to 90 set. So just keep that in mind. Be comfortable with the built-in error rate. So there is an error rate. There can be an error rate in data. There can be an error rate that sometimes filters through. I have a great team who we try and catch all the errors we can, but occasionally there may be a bad piece of data that comes in, and that can really, really worry some people. But what I've learned is that the error rate in data is so much lower than the error rate in human biases. And I personally believe that if you actually analyze analyst forecasts, there was a great study done by, I think it was James Montier, or he quoted it, that showed that analyst forecasts of profits for next year are on average 47% wrong. And so the error rate on human speculation is often a lot higher than it is on quantitative. So I've learned to become comfortable that if I buy a set of 20 shares, there may well be an error in there, and there may well be 1 or 2 or 3 shares which possibly have errors. And I think it's an important point. The other thing is, understand that stocks in distress, which have a red flag on the stock report, like a high bankruptcy risk, may occasionally rank highly. In general, they'll rank lowly, but on sometimes they will occasionally have a high ranking. And this really, really worries some people. And they think it's like, they worry the whole system is under question because of that. There is actually a subset of high bankruptcy risk shares that do outperform. And our approach to the rankings using value and momentum and quality aims to try and isolate the ones which have a higher probability of actually recovering. So you may find very cheap shares that have a high leverage, but there are other complementary or opposite other drivers, such as other factors of profitability or momentum, which override that red flag. And we found a lot of turnarounds, a lot of stocks that have done well. I'm thinking one at the top of my mind is Wincanton, which did exceptionally well when basically everybody said this should not rank as high. And I think it does add weight to this idea. Also, common mistakes in using the rankings. One of the things that I see people do all the time is going on and looking at the set of high ranking shares and selecting the shares they know best. Or just going and seeing a tip somewhere else, coming to the site, checking the rank and going, oh, it's high rank, I'm going to buy it. Now that's okay, but it might lead to subpar returns. Often it's the shares that you're least comfortable with, which actually end up outperforming the best. And this is something that's known and it's analyzed called familiarity bias. And I would say to challenge yourself sometimes to go and dig where others aren't. I would also say be aware of the risk rating of the stocks you select using the stock ranks. There can be higher volatility shares in there, and you do want to think about sometimes having a certain core of more conservative balanced shares in your portfolio rather than going out for out and out high risk shares, because when markets do turn, more speculative shares do tend to drop faster. I also see people not using adequate diversification. This was absolutely my biggest mistake in 2008. I had 5 stocks in my portfolio and 50% in my biggest position. I now structure my portfolio with at least 20 shares equal weighted, as I've learned that it's not just this company specific risk that matters in the market, but factors drive returns. All the research shows you need at least 8 stocks to reduce risk to manageable levels. But if you want to ensure capturing the returns of factors, 20 plus stocks actually works best. And the other mistake is not rebalancing a portfolio over time. So stock ranks will drift over time. You might see a stock ranked 100 falling to 50 over the course of a year. And factor investing really does rely on active management of a portfolio. So it makes sense to rebalance over time. How frequently you do that is down to the factors you use. Now, before I go into the performance, I want to show you a little bit about the traits of high stock rank stocks, because I've done a lot of analysis on this, and I did it again last night. This quote from J.R.R. Tolkien, who wrote The Hobbit and The Lord of the Rings: "You certainly usually find something." I think this is a quote from The Hobbit. "You certainly usually find something if you look, but it is not always quite the something you are after." How do we know, if we rank the market for quality, value, and momentum, that we will actually end up with high quality, cheap, high momentum shares? We don't. If the market's efficient, the best quality shares should actually be higher priced. So I like doing this analysis to almost test the factory to ensure that what we find is what we're looking for. So this slide shows, again with the stock rank on this x-axis, with the higher ranked on the right. The higher the ranking, the more profitable the company. And you can see here up to 18% return on equity in this higher ranking sets of shares. And there's this trend up, which is very, very, very noticeable. So they are indeed higher, more profitable shares. The higher ranking, the faster the growth. And I think this is a very interesting emergent property of the stock ranks, because we're not explicitly using growth as a ranking measure. I said earlier, you can see here actually, we took it out of our composite ranking. And the EPS growth of the highest ranking set on average is something like 30% over the last 12 months. And I think that's an amazing insight. Also, this is extraordinary, this chart. The higher the ranking, the cheaper the stocks. And it baffles me that you can do all this work and then you find that the price earnings ratio, which when it's low, this is the price earnings ratio and the price to free cash flow ratio, it goes down as the stock ranks go up. And it goes down extraordinarily quickly. And the highest ranking shares are actually more at around a P of 10, which is amazing. The higher the ranking, the lower the broker expectations. Here you can see the forecast earnings per share growth, the forecast profit growth is the research analysts are predicting far higher upside for stocks that have low rankings than they are with stocks that have high rankings. That's weird. The upside to the broker price target is far higher for low ranking shares. And look, this is a logarithmic chart. This has this is not a linear axis here. So I've had to change the axis so that you can really see this this effect. And I think that's extraordinary. So what does that say? Does it say like, oh, the brokers aren't hot on these stocks? We shouldn't necessarily look at them? Well, no. The higher the ranking, the more the expectations are being proven wrong. So as the stock rank goes up, you can see that about this point, the green line is the 3-month change in the profit forecast. So at about this point, about 65 stock rank, you start seeing that in the last 3 months that the brokers have been having to upgrade their profit forecast. And for rankings below that, they've actually been having to cut them. So they've basically been over optimistic on those shares which are lower ranking, and they've been under optimistic on the other ones, on the higher ranking shares. And then we can look at the price change. The higher the ranking, the more they've been beating the market. So this yellow line shows the 1-year relative strength of these stocks, with the highest ranking shares having the highest average share price performance over the last 12 months. And so I think this really shows that we are actually finding the a really unique set of shares with this stock rank system. I did this in a blog years ago. This is a refresh of the data. I thought these because of the run in the market the last few years, that we wouldn't find the same results, but we did. So can I make, if I look at for shares that have these traits, and these are the traits of the top 2% of the market, and you actually screen for them: high profitability, high return on capital, high margins, cheap shares, so a low PE, high yield, a high relative price strength, and beating their broker expectations. How many stocks do you think you get if you screen for them, which is what the majority of people that do use data do in the market? You find no shares. I did this again a couple of nights ago, and I found no companies in the list. Okay, so you go and try and find shares that have those attributes. You cannot find them in the market. But a 98 plus stock rank portfolio has these traits on average. And this is a very important insight into the stock ranks, because they rank all the shares at the same time. Individual shares will have something going badly for them. I mean, look, if I take a line here for example, Antofagasta, it's actually not had a positive earnings surprise recently. You might find a share that's gone down. iEnergizer gone down 20% in the last year. Every single share in this list and will have a wart, will have something that's to hate about it. And that's, I believe, one of the kind of most important points about stock ranks. Nobody likes to swallow a frog. If everything has warts and looks like a frog, why is anybody going to buy them? That may be, again, one of the behavioral reasons why we don't like buying higher factor exposure shares. Right, I've got all that over. It's actually been almost an hour. If you're still with me and I haven't lost anyone, I will be going into all the performance history and then going into looking at the usage on the site. As I said again, this is a long webinar. We're going to chop it into chapters and we're going to put it online, so you will be able to catch up again anytime. So let's go and look at this. How to understand the performance charts on the site. If you sort all the stocks in the market in order of increasing value, quality, or momentum, for example, for value, we would sort them from cheapest to dearest, and then we'd split them into buckets. So this is split into 10 buckets, but it could be 5. If it's split into 10 buckets, we call those deciles. If you split it into 5, you call them quintiles. And then we track those buckets over time as a portfolio. And on a certain period, which might be quarterly or annually, we would then do exactly the same process again. We would then sort the market again, split them into buckets, and rebalance each of those portfolios into them. And that is how we create a chart like this. And this shows the 5-year history of the stock ranks, and it shows this almost perfect sequential performance history from high-ranking shares, 90 to 100 ranked, down to 0 to 10 ranked shares at the bottom. I personally have been astounded by this. I could not have believed 5 years ago that if we ran this system for the next 5 years, that you would find this and you'd find these results. I have been investing in alignment with the stock ranks over all of this period, but I did not understand it would be quite as fantastic a return. So 20% annualized for the very highest bucket of shares. And I think, and the other thing is that they've been in perfect sequence, which I've showed you this slide a couple of times, but they are actually in perfect sequence as you go from high ranking to low ranking, which is quite extraordinary. When you're looking at these charts on the site, and I'll show you the URL and how to find it later, be aware that the green line is always, the dark green line is always the 90 to 100 rank, or the top rank bucket, and the deep red line is always the lowest ranked. And the pale green line is the 80 to 100 rank. Now, hit rates. As I was saying earlier, there's a big distribution across all the different stock rank, the distribution of outcomes for every stock in these buckets. Now, if you're looking just at the UK market, and I'm using this as an example for these statistics, you would have, let's say, 150 shares in each one of these buckets. And you can calculate a win rate. If you were to hold that share for 1 year, create that bucket of shares, hold them for 1 year, and at the end of the year, find out how many have beaten them zero, how many have actually lost money. And in blue is the number of shares on average over the last 5 years, if held for a year, the number of shares that have actually beaten zero and been winners. And you can see that's actually a 2 in 3 chance of picking a winner in the highest 90 to 100 ranked set. And it's almost a perfect inversion on the other side. In the 0 to 10 ranked set, there is only a 1 in 3 chance of picking a winner. So I want to make this clear. You can still pick winners in lower ranking shares, but the odds are lower. I like placing my bets in high odds situations. And of course, the more stocks you have in a portfolio, the more that this really, really, really matters. And this is showing you, this next slide shows you the distribution of returns, which is actually set out as percentiles from the best performers to the lowest performers on average over each year, set out in actual centiles. And you can see that there are far more winners which are above the zero line. 67% were winners in the 90 to plus 100 ranked shares, whereas there are far more losers, some of them very bad, in the low ranking set. But what is interesting is in the low ranking set, there are occasionally some much bigger winners. And year to year, sometimes you can find some shares that go up a few 100%, but you might find a share that goes up faster in low ranking shares, but your odds of finding them are far lower. So it's important to understand that. And this chart actually shows it even more. Now, all these slides we're making available to all of you who are on this call, and you can go and dig through all the numbers. This chart shows you the median win or average win in that bucket, if it's a winner, and that's the average loss in that bucket, given a loss, and the average performance is there. So you can actually see here that the average loss for high stock rank shares tends to be far, far, far lower than any other segment in the market. But the average win is not necessarily far, far higher. The actual average win, if you do get a winner in the low ranking shares, can be higher. But your chance of getting a loser is far, far higher. So I think that's a nice insight. Next, have the stock ranks worked across sectors? I often get this feedback from people that, how do I know I don't trust it for this sector or that sector? And so I've done an analysis on this, and this will show you across the 10 broad economic sectors that we track on Stockopedia. These are the performance of the top 20% by ranking, and the bottom 20% by ranking. And you can see that every single sector, there has been a positive return for 80 plus ranked shares and a bad return for 20 minus ranked shares in all almost except the energy sector. And we've done the ranks have done especially well across healthcare, basic materials, which includes the chemical sector, consumer defenses, tech, consumer cyclicals. But obviously the energy sector, which is very, very heavily weighted towards oil and gas shares, it has not done as well. And I'm going to quickly cycle through some of these charts. You can see that actually in the energy sector, almost it's been a bad time for energy shares, oil and gas shares. So the whole chart is a bit all over the place. But you can see that there isn't that nice outperformance for high-ranking shares. But if you look at almost any other sector, basic materials, you get this radical outperformance of the top ranked set of shares. industrials, consumer cyclicals, which includes all sort of like, consumer, more heavy goods, consumer defensives, done particularly well, foods, beverages, those kind of stocks. Financials, done extremely well as well. I mean, many people say that, we should use different ranking systems for different sets of shares. And the thing is that the stock ranks are doing very, very well. Maybe at some point we will create a different banking rank, but as we can see, they work very well across sectors. Healthcare stocks, amazing returns in the healthcare sector. We've seen more like almost 300% returns there over the last 5 years. Technology, the top ranking set did not outperform the most. It was outperformed by the next bucket down, but still having done very well over that period. And in telecoms, you see a spread. And in utilities, there is also another spread. I sometimes get a question as why you get these flat lines sometimes in these charts. And it's because we're using the stock rank. And if no stock is in that bucket for a quarter or a year, there will be a flat line. We'll hold that because there's just basically no candidate stocks in that set for that period. Have they been robust across size groups? Okay, this is the performance of the stock ranks against different size groups, from micro cap shares, small cap shares, mid cap shares, and large cap shares. Very, very strong performance in micro caps. And in the last 5 years, there's been an economic recovery of sorts, I guess, a kind of slow recovery from the financial crisis. And actually, micro caps as a whole have done reasonably well. But you see I don't like buying micro caps myself because they can also do really badly in bad times. But you can see that smaller cap shares have done better than larger cap shares. But even in the very, very top set, which is effectively FTSE 100 shares, there's been a 9% annualized return. And that's important to understand. I don't have the number on the top of my head, but the last time I looked, over this period, the FTSE 100 had done 4% a year. So there was about a 5% annualized return in the biggest, most liquid shares in the market. And anybody who was just buying a set of large cap shares that had high ranks would have done very, very well. So all of these have been fantastic returns. And as I said, I must reiterate, past performance is not the future. And we hope the future rhymes, but you can never predict what's happening next. And again, just to show how pervasive these rankings have been in the market, Ollie, who works with me, has put together this great hit rate chart across the different size groups. And you can see it's an over 60% hit rate for the top 90 plus set of ranking shares in large caps, mid caps, small caps, and micro caps. So that same sort of batting average has persisted across the whole market. Now, this is very interesting. Have they been robust across regions? Now, a little bit of context. We launched the stock ranks in the UK 5 years ago, April 2013. By about July that year, we'd launched our European coverage. The next year, we launched US coverage. And then we've added in 2 years ago, Asian coverage, Canadian coverage, Australian coverage. And next year, we'll be adding in the rest of the world. So there is different amounts of history for each of these regions. And some of these trends tend to out over longer time periods. So we've seen the UK chart. I'm not going to show it again. But what about Europe? In Europe, we've seen absolutely astounding returns, actually, and almost a stronger picture than the UK. This is across almost the whole sort of Eurozone. It includes Turkey. And as you can see, this almost perfect spread between high and low ranking shares. So the subscribers that have taken our European add-ons have had a particularly strong period in the market. And anybody that likes using a specific data-driven strategy, I would really encourage them to think about expanding their universe of shares because, for example, I've always been a keen Slater investor, Zulu principal investor. Lost that for a moment. And when we launched the European coverage, I was like a kid in a candy store, as there were only about 5 shares in the UK that qualified for Jim Slater's principles. And when you expanded it to Europe, suddenly you've got 30 or more. So it's really is like being a kid in a candy factory when you expand your coverage universe. Australasia. Okay, high QVM has again outperformed. You can see this top 90 to 100 rank set has outperformed. We've only got 2 years here, so the picture is emerging but not totally clear, but it's quite noisy. there's been a bit of a recovery in resources stocks at different times. And also, so these red lines have been a bit all over the place. But you can see this green line, very low volatility, smoothly outperforming the market and actually doing best. And we've seen a very similar picture in Canada, which again has a very resources heavy market. You get these massive spikes in highly speculative sets of stocks. But again, this higher QVM, high stock rank set has smoothly outperformed. And I think that's important to see. As I would anticipate, if the future rhymes like the past, that you will see a gradually improving spread across all these different buckets as time goes by. India absolutely cracked it over the last 2 years. Since we launched the coverage, huge spread between low ranking and high ranking shares. I mean, a lot of people say in India, where actually we do have an office, and some of the team may be watching this. Many people say, when I launched it, said, "Oh, India is all driven by sort of insider knowledge and but it doesn't work like this." And the thing is, I think we're showing here that these factors are quite pervasive. They work across regions and across time zones. And in India, unfortunately, I can't trade in India, but anybody who can, this has been a very fortuitous time. Japan, a much tighter spread, much less differentiation between each of the deciles. And one of the reasons is momentum famously has not worked in Japan as a factor. So actually, if you use the QV rank again, which I won't show you right now, there is a much wider spread between high and low ranking shares. And that's worth remembering. Hong Kong and Singapore, again, very wide spread between high ranking shares and low ranking shares. So it's done particularly well in this part of the market, which is more easily tradable for international investors than certainly the main market in China. And we've put these two markets together because they're smaller. But I think you can see that very clear picture is emerging. What about the USA? In the USA, the results have certainly been more disappointing for QVM, the stock rank. You can see it's sort of in the middle of the pack here, and the blue line being the S&P 500, which is very hard to beat. One of the reasons for this is that value has not been working in America. A lot of value funds have suffered, and a lot of people have been saying there's the death to the value effect. And if you actually strip value out and you look at the QM rank, quality and momentum, you do see outperformance. I think it's worth pointing out that the US is a very efficient market, and it's very dominated by those massive firms, especially those massive tech firms. But I think this does illustrate the point from international investing that different factors work in different regions at different times. QVMs work best across most regions, QM in the USA, QV in Asia. And certainly I would say you want to favor more inefficient markets for maximum returns. Over time, you might see markets trending towards that US model of having stronger regulations, more standardized reporting, high frequency trading, etc. And that makes outperforming indices harder. And I've seen this in academic research as well. Again, why is outperformance so persistent and pervasive? I believe it does come down to these behavioral biases, this resistance to buying cheap shares, a resistance to buying good shares, resistance to buying strong shares. And I think this is one of the reasons why that we see these factors outperforming across sort of the globe. Anyway, I'm now, before I go onto the site and give you a demo, my last 15 minutes, I'm going to go give you a quick whiz through what we call the StockRank Styles. This is the StockRank webinar, and I think the StockRank Styles fit in it. I know some of you will have seen some of my work on this before, and I think this is just one of the it's one of the coolest things on the site. And we came up with the methodology for doing this and classifying all the shares in the market according to different archetypes based on their stock rank exposure. So just to very briefly help you understand this, you can think of different combinations of stock rank. And if we look at, for example, quality, value, momentum of a share, and they might have a numeric score, we can map those to this visual idea of higher rankings being green and full and lower rankings being red and small. And you can combine the three ranks in this binary way in 8 different combinations, which I sort of like to joke is like the I Ching of the stock market. For anyone who's read the I Ching, you might understand what I'm talking about. If not, give it a Google. Anyway, super stocks. Super stocks tend to have high quality, high value, and high momentum. And very easy to understand. They have all three factors going for them. Very strong, high factor exposure shares. Quality and momentum, but not value. Okay, so you might have a company like Amazon. It's a very good share. It's got very profitable. It's got high momentum, but it's very expensive. And we call these high flyers. And there's a label right under that stock quote on the stock reports where you can find this classification. And I'll show you how to screen for it in a minute. There are other combinations, like what about a company that's like quality and value, but it doesn't have momentum? It might be on a dip. The share price might have fallen. So it's high quality, it's good value, but it's currently got bad momentum, a bad trend. This is the classic style of contrarian investing that people like, for example, Warren Buffett and contrarian investors like Neil Woodford might favor. And a sort of type of stock that is showing this profile at the moment is ITV. And I would say that there's a lot of value investors do flock around this style a bit too much. Everyone likes a bargain, but I believe that going against momentum is not one of the best routes to fortune for private investors anyway. Turnarounds. Imagine a company that has poor current quality. It's a bit junky, but it's cheap and it's got strong momentum. This is the profile of a turnaround. Barclays there is a bank in the UK that has this profile at the moment, or it did when I printed this up. And turnaround investing has long been a style and a thing that's been marketed to investors, even in fund management. In the UK, there have always been a lot of recovery funds. They may be a bit more out of vogue now, but recovery funds would go and try and find sort of currently depressed shares that were on the move again, and it can be a very good way to beat the market. But what if you didn't have two factors going for you? What if stocks only have one factor? So this is an example of a high quality share that's very expensive and has currently low momentum. Its price is falling. I call these falling stars. They often were high flyers in the past, but they may still be high quality companies, but they've got less going for them now. There is also this dreaded value trap, which value investors always love to go and look at cheap shares. So this company is very, very good value, cheap share, but it's very low quality, very low momentum. And that is the domain of value traps. And it's, if you buy a value trap, it often doesn't have good outcomes. Two more to go through. Momentum traps, very high momentum share. The price is going up, but the quality is very low. There's no profit and it's very expensive, possibly because it's gone up so much. And this is something we call a momentum trap. You're gambling that either the company will start giving off profits or that it will eventually get less expensive. And that's not necessarily a very high probability bet. And the last one is, which I have the most fun with of all, is called the sucker stocks. All three of these basic rankings or factors are bad for these kind of stocks. Tesla, whose cars I absolutely love, is currently labeled as a sucker stock using this framework. And you can think of this framework, you can draw the line and you can look at stocks that are strong in at least two or three of these factors or stock ranks are winning styles. We call them winning styles. And whereas stocks that are weak in at least two or three of these factors are losing styles. And this goes in a spectrum from super stocks to sucker stocks. And can be quite controversial, I know. The labeling is designed to be quite provocative, to make you think twice about what you are doing and to make you double your research. So if you are buying lower ranking shares and you see a label like sucker stock or momentum trap, just remember and think back to those win rate slides that I showed you earlier, which shows you that you have certainly you've still got a chance of finding a winner in these buckets, but it's just a lower probability. If we look at the performance of these, just before I go on and show you the performance, you'll find the styles right here at the top of stock reports. There's the risk rating, there's the StockRank style, and you can always refer to it there at any time. Roughly there is about a third in each of three segments. Winning styles is about a third of the market in losing styles, and a third of the market in what we call style neutral. And that is very important to remember. There will be a third of the market in this neutral bucket. And all of this is on the guide, and I'll distribute the slides afterwards. When it comes to performance of the StockRank styles, super stocks have outperformed the most. And you can see the winning styles have all generally done better than losing styles. Of all the losing styles that I would consider owning, falling stars would be the best because they are high quality shares and they don't underperform as much. The market favors quality. So if a stock that I had was a high flyer and it did fall into a falling star bucket, I might not instinctively sell it. But I would certainly be very, very wary in sucker stocks, value traps, etc. There's just an opportunity cost to buying these kinds of shares, and the statistics have been proven historically to be worse. And this is again a win rate slide, but instead of using the rankings, it uses the classifications. And you can again see that super stocks have a much higher probability of selecting a winner than sucker stocks. So I think that's important to understand. I would just say, when you're using all these rankings, I'm going to go on and actually show you how to use the stock ranks, but you must sort of think about the style of investing which best fits your psychology. If I go back and show you, all of these different styles, many people I know are very, very effective contrarian investors. Some are very, very capable growth investors. And you really should be thinking, if you really don't like using momentum, or you don't like using value, or you don't like cheap stocks, that it's good to think about your psychology and how to design yourself a system which works well. So we have been going a long time. I did say this was going to be very, very in-depth. I'm going to go and show you how to use the stock ranks on the site now. So if anybody is still with me, I am now we're going to spend about 20 minutes going through some of the features. So very much, first of all, let's go and look at a share. I'll just bring up BP as an example. Here it is. And hopefully my internet connection is good. This is actually currently labeled as a super stock, which you can see here. The stock ranks are all up here on the top right, and the labels are here. So this is the risk rating. This is the StockRank style, and this which shows that it's generally got good, quite positive numbers for quality, value, and momentum. I think I should be able to zoom in and show you a little bit more closely some of these numbers, because I know they can be a little hard to see if you're online. There we go. Okay, and you can click any of these and you can get yourself you can go and read a little bit more online in the guide. I would encourage people to go and read the guide, by the way. If you click any of these, you'll go to the guide. Occasionally, you will see arrows up and down here, which will, I'm a bit annoyed I don't have one on BP, but a little arrow could be up or down, which we call the deltas. And the deltas will only appear in an instance that a rank has changed by 5 or more in the last 30 days. And it's a good indicator of when there have been recent changes. And so you'll see these green and red arrows just to the left of the stock ranks. And that's a useful thing to know. I'm often asked how to view the historical rankings of a share. And there is a print button here that you can print the stock report. But this little arrow, if you click it, you can then go way, way back into the past, and you can select an old stock report, which should just bring it up, and you can see the stock ranks, which might have a slightly different design, on any of those dates when we've actually stored the stock report. And that's a useful way of going back in time. And we are going to be charting the stock rank on stock reports later this year, actually. So stay posted for that. I now want to go on to number 2, analyzing your portfolio using the stock ranks. So if you have gone and looked at the stock rank, you can go and add it to a particular portfolio. So if I go through and I view this one, okay, here is a portfolio or a watch list of shares. Now, as you can see, the default view is a quotes view. It doesn't have the stock rank on it. We probably should change that. But this tab here that says ranks, if you click it, you will get all the stock ranks for your portfolio or your watch list, and you can sort it, and you can go and have a real dig into the numbers. We've got the quality, value, momentum rank, and that's pretty useful. It's important to know that if you do have a default view and it's not how you like it to be, you can add the stock rank at any time to that view. So if you click here And you go to this. This allows you to edit the. So I'll do that again. There's a little blue icon here on your active tab. You can click it, and it opens a table editor. In here, you can see the stock ranks and all those basic ranks, Q, V, M, G, and the crossover ranks I talked about, quality, value, value, momentum, and the overall stock rank. They're all available here. So you can add it, and you can add any set or any different version of these as you like. And you can then move it around. You can move it around wherever you like, and you can recompose your view in a way that best suits you. So for example, let me just add quality, value, momentum. We've got the overall stock rank. And also because I like being able to see the style and the risk rating, I can go into profile, and down here you can see there's the risk rating here and the style. So I'm just doing this for demo. You can do this however you like. Let me just move that, and I can save the changes, and I've completely rejigged my view. So I've got a risk rating, a style, and I've got quality, value, momentum all there at all times. If you decide that you've duplicated another view accidentally or screwed it up, you can click the blue icon again and click reset to default. And that will get rid of all the changes, which I won't do right now. That's a useful way of doing it. Also important to understand, you can do your own analysis at any time by exporting to a CSV. So you can click download, and you may have to install Flash in order to do it. I will run, I'm not going to, this is not my computer, so unfortunately, oh, there it is. And if you click that, it will download a CSV. And you can then, CSV is a comma-separated file, comma-separated values, which you can then upload into Excel or Google Sheets, or if you're on a Mac, Numbers, and it will add the whole portfolio up there, and you can do your own analytics. And obviously, we've got 350 other financial ratios which you can use as well. One sort of obsessive tip, which many people don't know about, is if you click these in a table, you will get a little pop-up, which now is refusing to load because I'm on a webinar. But once that loads, it will actually show you a breakdown of your rankings for that stock. So I'm not sure why that's not loading, but it should do. In most cases, it will. So if I do that for BP, there it is. So BP ValueRank, you can see those 6 different factors we talked about. You can see how they break down across this stock and how it's all put together, which is a very useful way and a useful feature for anybody who doesn't already know about that. The other thing that is very good to know when you're analyzing your holdings is this nifty feature called the bubble charts. And also, hang on a minute, making a note, something I forgot. Clicking the bubble charts is a really fab way of looking at your portfolio. You can see the quality rank is on this axis from junk to good, and the value rank on this axis from expensive to cheap. And the bubbles are the stocks in your watch list or portfolio. And as you can see here, it's labeled good cheap stocks tend to outperform, expensive junk tends to underperform. And really, you know, if one is targeting higher factor exposure stocks, they should be up in this top right corner. Similarly, we can go and click over here, and you can look at quality versus momentum or value versus momentum. And it gives you a great lens on your portfolio, and you might think, oh, that stock has lower value and momentum. Is that one I want to think about rebalancing out? If we were to go through and go and look at that stock, one thing I haven't shown you yet is you can set StockRank alerts. So any share on your portfolio, and you can do this in one of 2 ways, by the way. You can do this from a table view, all from a stock report. So there's BP that we added to our portfolio. There's a little icon here on the right, and you can set alert. Set alert. Search for StockRank. I'll tell you what's happened. Because I've zoomed in, it's letting me do it, which is rather annoying. I think I've got a problem. But anyway, you can search for StockRank in there if you are on a better Zoom, or perhaps if I was on my own computer. But you can set an alert that way. And also you can set an alert for the same thing from any stock report by clicking the Set Alert button. Once again, yeah, there we go. Crikey, that's a stock rank. Not sure why. And you can go, for example, if you want to set an alert, stock rank less than, let's say, 85, you can save the alert, and you will get an email and notification when that is released, when that happens. And that can be a very useful way of, for example, if you want to rebalance a portfolio only on a specific stock rank decrease, etc. Now that I've shown you a little bit about how you might put a portfolio together, how you might actually analyze your portfolio using the stock ranks, I'm going to show you how you can build a portfolio. So let me go to another, I think, an empty portfolio, which is here. And the way that I would build a portfolio is, number one, using the StockRank portal. So up in the navigation here, not sure why it's not letting me zoom in. But up here in the navigation, you can see ranks, top stock ranks. If you click it, you will go to this portal, which will give you all the stocks in the market, or whatever your subscription is internationally, or just at your local market. And you will see all the stocks ranked in decreasing stock rank. Now, this is a very, very useful tool for stock rank investors. You can see the filters on the left here. If I was to choose another ranking, for example, if I want to focus on quality momentum shares, I can use this filter to filter by the QM rank instead of the stock rank. Or I might just want to look at the highest quality shares in the market. And this filters down here, 100, 99, 99, 99. And we can start adding more filters here. We could filter by sector, or we could filter by, for example, risk rating. So we could look at lower risk shares in that segment. And we could also look at size groups, large caps, mid caps, etc., etc. And then also looking at styles. So if I wanted to find super stocks, there may not be any in this bucket. There are. So you can see here, these are super stocks ranked by QualityRank, which have lower balanced risk. And so you can see it's a very, very quick way to go and find shares, which you can then go and have a dig through and decide if you think some of them are worthy of further investigation. You can click the check boxes and add them to a portfolio. So let me add them here. And there you go. These have all added into this portfolio. And because I've customized the view earlier, I can see them all here. Now, what if you want to go and dig even deeper? One of the best ways to do that is in the screener. So I'm just going to open up the screener. I'm going to do it in a new tab, actually. And why it won't let me zoom in? I'm pressing the wrong button. Because I'm not on my own computer, things are going a bit haywire. I have a different keyboard. And if I was to create a screen, and this could be StockRank screen. The easiest thing to do is just to go and, like, for example, start searching for the stock rank or any of the other ranks, the composite ranks or crossover ranks, and you can find a share that might be greater than a certain cutoff. But of course, you can add different rules. So if you're a dividend investor, you might be someone who's interested in yield. So you can find all types of yield here and look for, a yield greater than 4%. Maybe you also want to ensure that the quality is particularly high, because a high stock rank does not always mean it's got the highest quality. And I could filter for quality rank greater than 90. And you can build up these rules again and again. And you can see there we've got 20 shares which have a quality rank greater than 90, a yield greater than 4, and a stock rank greater than 75. And if we keep editing that, we can filter that list down even further. And that's you can see here, some of these are very, very, very small caps, and we might want to keep them out. So I might add another rule, which is, for example, to just remove small micro caps. Now, there's other videos and webinars about how to use these features, use the screening feature. And you can, of course, go and dig through those in the guide at any time. If you want to get to the guide, go up to help and go read the guide. And, of course, you can go and dig in. The area you want to go to is the product guide. And you'll find all kinds of very, very full pages on custom screens, guru screens, etc., etc. And you can normally find a little video here which will help you, which is a much shorter period of time than giving up an hour and a half of your day to listen to Ed on a webinar. So anyway, that's the important point for that. And I did show you a variety of things. One little sort of sort of tip for people that do like focusing on specific style of investing. So I know there are a lot of people who like focusing on high flyers in the community. And if you are doing this, it's worth coupling that style with a crossover rank, which might be more aligned with it. So, I was talking about styles having 2 or 3 rankings going for it. And so you can think of high flyers, I would use the QM rank, contrarian stocks, the QV rank, turnarounds, the VM rank. And that's quite a useful tip. So once again, you can, whenever you've done a screen or anything, you can use those check boxes and put in your portfolio. Now, something that I mentioned Ian Wright earlier, and it reminded me, the other thing you can do with the ranks is go and look at the movers. He told me recently that his what he does every day is he goes to this page, StockRank Movers, and using this page, he will go and scan it every day for big changes in StockRank. This is a very useful feature. You can load up any of the ranks. You can look for stocks rising above a certain limit. So, for example, 90 in a certain time frame, last week or month, in whatever region you've subscribed to by a certain number. So let's look, stocks moving up by at least 10 ranks in the last week. And you can find these shares that have had big moves. So if I go and look at one of these, so for example, Drax, we can see its stock rank has suddenly shot up. I've had mixed fortunes with Drax in the past, but you can see the reason why this has shot up is because recently the momentum rank has increased, an increase of 13 in the last 30 days. And so that StockRank Movers page, which is up here and there, is available at any time for those who are quite obsessive. The other part of the StockRank portal is to look at the performance page. Again, it's available here from the performance dropdown or on any of the tabs when you're on any of the main StockRank pages. And you can go and dig a bit more deeply into individual rankings and look at the performance charts over the last however many years. And so if for example, I want to look at value, and I mentioned value is a lot more volatile than other types of investing. And if I was to go and remove, I could show you how much more volatile high value rank shares have been than other types of ranking. You can see here that at one point, because of the riskiness of value high, very, very cheap shares, they actually fell an enormous amount in this 10, 15% drop in the market. They fell far, far higher. So you can see, yes, they have outperformed, but when markets turn, cheap shares tend to suffer from distress. So, always bear that in mind. You find if you go and look at different rankings, for example, momentum, you find that declines are potentially have been lower. In fact, the declines using the momentum rank have been far, sorry, I don't know what I did there. Click all, Ed. There we go. Click all. Don't know. And the declines were actually lower for the value rank. So that's an important point. And I'm trying to think of anything else that I need to go through. Okay, so I've shown you most of the features that relate to the stock ranks. I've given a very, very long educational session on this. And I think I'm an hour and 40 minutes through. Now, I'm going to try and answer some questions. I'm not sure how many questions. There's probably been absolutely masses. And I'm trying to remember how to use this widget. So hang on a minute. I'm going to go to the bottom and right. I'm not sure whether chat's coming through at the beginning or at the end. Okay, Richard Croft, namesake. I know we do have. Sorry, I thought that was my brother. Thanks a lot, guys. Getting some compliments. Rebalancing. Question about rebalancing. We will be developing tools to help portfolio rebalancing in future. I'm not going to set a date. Setting alerts, fine. I'm just seeing if anyone's got any question. Netflix. Somebody's saying Netflix. You want me to analyze Netflix? Okay, Netflix. Somebody's asking to analyze Netflix using the stock ranks. It's no surprise to me that this is a high flyer. Okay, this is a classic. You can always sometimes you can just think of a stock and you go, okay, Facebook, high flyer, Amazon, high flyer, Netflix, high flyer. These are FANG stocks. And you can see that the value rank is very, 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 very low. Okay, that means it's super expensive. And that's, if you look at the ratios down here, it's on a P ratio of 100, which is I would, if somebody said to me, do you want to buy a stock on a P ratio of 100? I would say, no, I don't want to buy a stock on a P ratio of 100. Netflix, though, has enormous momentum going for it. And if you actually look at, and it's also very, it's high quality. Its profits are growing enormously quickly, and it's starting to get into a position of strength. Certainly, if I'm looking at this, it doesn't have particularly high return on capital over the last however many years, but if they are able to create a moat around their business, that may increase over time. Certainly, it's on a return on equity basis, it's actually looking quite good versus the rest of its sector. And so I like looking at some of these, I like thinking, why is that stock rank like 65? And this will give you some insights into it. Other things that I like to eyeball on the stock report, I like to look at the health trend. So I would say Netflix doesn't have a great health trend. I prefer buying stocks that are 7, 8, or 9. Certainly no risk of bankruptcy. There are no bad red flags. Really, I think Netflix, it's a punt on firstly whether you believe in the business model. Secondly, whether the market will continue to rise and whether the market will continue to favor these FANG stocks, Facebook, Amazon, Netflix, Google, these kind of stocks. The stock rank's only 53. Now, you see, it wouldn't fall under my investment criteria because I tend to use the overall stock rank as my main filter rule. But I know a lot of people that are very successful investing just in high flyers. So, what I'm trying to do in this educational session is help people understand that there are different ways to get to the top of the mountain. And, if you you look at some of these shares, Amazon, Facebook's been getting bad press lately. You tend to find these all have a very similar ranking profile, high quality, high momentum, but very expensive. At Facebook, a lot of people have been very bearish, obviously, with the Cambridge Analytica situation, but it's bounced back. It baffles a lot of people. But again, it's this kind of profile of high quality, high momentum, and high flyer. So I hope that that helps. Right, more questions. So I'm sorry if I don't get everybody's questions here. I have to admit, I'm going to just try and scan it. I'm wondering if I can filter just for questions. I'm not sure I can. Okay. Would you mind explaining how the growth rank is composed? Sorry, Richard, I will get back to you on that because I don't use the growth rank anymore. I could look it up in the code. I think it's one of the best ways to go and look at it. And I'm not sure if it's still available in the guide. And yes, it is. So if you go to the guide and you go and click on growth rank in the guide, you will get the basic the factors that go into it. So there are 5 factors in the growth rank. You can go and look at that at your leisure, and I hope somebody might send you the link. Next question, Alessandro. You talked a lot about Buffett, but I think he looks more company specific than factors. Absolutely, of course he does. Why is the stock ranking so low for Cattolica? I like that you guys are highlighting the individual stocks because it's certainly not something I did enough in the presentation. Cattolica. Okay, this must be an Italian insurance stock, if I imagine correctly. Okay, this is ranked as a value trap. This is absolutely ranked as a value trap. It's very, very cheap. Our rankings show that its quality is low and its momentum is low. And I would say what the reasons its quality is ranking poorly is because it has very, very low returns on capital, returns on assets. Now, I would imagine this is in the insurance sector. And I think if there is an improvement area that we can do for the rankings, it's around banking sector and insurance sector, because often these sectors have slightly different measures of quality. And I find that often they do rank more poorly for quality in the system. So I think if you are looking at analyzing at insurance companies, you can certainly, what you should be doing is looking more vertically amongst shares in that sector, rather than looking only at comparing them across the market. And if I was going to go and look at insurance, you would go into the sectors part of the site or click through to its sector and then have a look. And you might find that sort of certainly the rankings can often be a little bit lower in this sector. So, I think bear that in mind. Like I said, there are company-specific factors. And when you look at a specific company and look at its rank, you can often disagree with it. And if you're a good analyst, your disagreement might be right. We are running what we're calling a Stock Slam event in person in London this evening. And there will be a lot of people there the majority of whom are pitching lower ranking shares. And often it's because they think they've seen something that the rankings aren't picking up. And really, that's where the great insight of a good stock picker comes around. If I was to go, if I go back to my statistics, for example, if you go, this stock is a value trap, and value trap's possibly a 35-40% chance of picking a winner on a 1 year time frame. Obviously, Warren Buffett may know something that we don't. It could be a kind of case where he's picking one of the winners rather than the losers. A question on, will we be ranking investment trusts and funds? We will. I actually can't promise anything. The future is always uncertain, but we are planning on doing it at a certain point. It's not currently in production. Can you, let me have another one. I'm going to focus on StockRank questions. Let me have another look. There's another question on investment trusts. Right, I'm focusing on questions. Let's have a look. Okay, another question on investment trusts. I say, if you do, can you please show, if you do ask a question, please do classify it as a question, because I get a little red Q next to it and it helps me look at it. Can I please show the top ranked AIM listed shares? Yes, of course. So I would do this by going to the screener. So I go screens and I create a screen. And the AIM market, for anyone who's international, is the junior market on the London Stock Exchange. And there are certain tax benefits and inheritance tax benefits to investing on it. So I might, for example, do this. I might go stock rank greater than, let's say, 90, and add a new rule. Now in here, there is a little something here called market/exchange. And you can change this to UK exchanges. And then you can actually go and look at the AIM market. And if you use that and you click get qualifying shares, you will find high ranking stocks on AIM. That's 55 shares. Now, of course, you can go and filter it more. You can go and add P ratios, yield ratios. You can look in specific sectors, etc., just by adding new rules. But I hope that gives you a quick idea of how to do it. And you can also do the same idea while I'm doing that. I'll show you. There's another way of doing it, which is index constituency. In here, we do have the FTSE. You can actually go and look for FTSE shares in, for example, the AIM 100. And there are lots of indices in there, and I hope that will work. So this is the 90 ranked shares in the AIM 100, and there are 8 of them. So hope that's useful. I'm going to go on to the next question. I'm only going to have another few more. IQE. Someone's asking me for my views on IQE. I must say I am not giving out share tips, and anyone who's known me long enough knows it's not something that I do. I'm very much a systematic investor. I used to be a huge stock picker, used to go actually hell for leather on stocks I loved, but I learned better after 2008. So IQE was the biggest winner in last year's NAPS portfolio, which is a portfolio I run on the site. And so it's a portfolio I write about and have been writing about for years. And last year it actually went from December, it came into the NAPS portfolio, and it was held all the way for a year till the end of the year back there. And then it was sold and hasn't done so well since. Like I said, I know nothing about IQE. All I do is look at the ranks. So this is a 33. There is a higher quality rank, but it's not good enough for it to be in the, it's not strong enough for it to fall into a specific category. So it's very style neutral. It's speculative. I don't know enough about it, but if I was looking at this, I would go, okay, firstly, rankings aren't good. Secondly, it's only passing one stock screen, and that's a short selling screen. That's a red flag for me. I've immediately got 2 red flags. The other thing I would look at is go down and look at the broker trend, which is really showing you the earnings momentum. And I see the earnings momentum has started coming off. Also, I can see here that brokers have been cutting their numbers. So a lot of those things I don't like. And although that some of the other metrics are more positive, I wouldn't, if I was a holder, I may well hold. The quality is higher, but if I was a new investor, I certainly wouldn't be considering it. And obviously do your own research. Can we please cover Saudi Arabia? Do you know what? We've got all the fundamentals for all the Middle East in the system. We're not publishing them yet. We're trying to reconfigure the subscription system. So, Osama, I can actually say that they will be coming. Yes, Ken, we will be showing a graphical representation of StockRanks over time. We actually have a new version of the site that we are putting into beta soon. It's taking a long time because it's being done very professionally. And anyway, any other questions? I've answered a couple of IQE questions. And if I don't want to go on too long, I think this webinar has been, let me see what the time is, 2:50. I think I have to cut it off at the 2-hour mark. We will be covering Latin America, absolutely. We will be covering, and also any of the other Asian markets that we aren't following. We have African coverage coming, Latin American coverage, Middle Eastern coverage, and the rest of Asia coming. So that will all be coming. It will not come this year. It will be coming next year. And I will not promise a date. So I will give a range. But it's very much part of the plan. So please, I hope you can be patient till then. The other thing I wanted to point out is that we do have, if you go over the home and you go and look here for StockRanks, you will find lots and lots and lots and lots and lots of articles about the StockRanks. I've done a lot of articles over the years. Ben has done lots of articles over the years. Others are contributing as well. And it all started around that time period in 2013 that we launched the ranks. There's a lot of content in there. And actually, if you were, you can go and perhaps, and another way to go and find the best content is to go to actually the discussion board. And if you go under methods, you'll see a link here called StockRanks. Click it, and you'll find all the content that's been tagged StockRanks in the last however many years. And you can then go and use these sub filters. For example, you can look at the most popular StockRanks articles in the last decade. And you will find some of the NAPS portfolio pieces that I've done, which give you a lot of insights into actually managing a portfolio. And you'll also find community articles as well. This is a great one from Grinder Trader, who's a great guy. He's a friend, and he's been running a StockRanks portfolio for a long time. So there's lots of good stuff to get into, and that's one of the best ways to filter it. So that's just another thing I should have actually put into my main presentation. There will be a book coming. I've written about 20,000 words on this topic, and I will be doing more on this subject later. So keep your eyes open for that. I will also be doing more videos on this. I'm going to break this material down into more bite-sized pieces so people don't have to go through 2 hours. Okay, now that's actually one. There is and on content, I would also say go home and you can go to the NAPS portfolio, which is everything about the NAPS. Before I sign off, the NAPS portfolio, someone's asked me, will I be giving an update? I will at the end of this month. I tend to do my updates every 6 months. And I will be giving an update on the SNAPs and the NAPS, which is a systematic portfolio based on the StockRanks and practically only uses the StockRanks. The other last question I want to answer is, do I think that QVM, okay, great question here. Craig, you talked about factors being arbitraged away in the past. Will this happen to QVM when the big institutions cotton on? Okay, I think the first point I want to make is that the institutions have many institutions have cottoned onto this for decades. Let me just go back to my slide. And there's one reason, if I go back to this slide, which shows you the factors, certain factors that have been most persistent and pervasive. There have been lots of factors. For example, people talked about directors' dealings as a factor, like when people do large directors buying purchases. People talked about, I'm trying to think, the accruals anomaly being when companies actually have more cash flow than they, when they're generating more cash flow than the profits. These anomalies actually were published in academic papers, and then they didn't persist. So they were arbitraged away. And I think that somebody actually wrote a paper about the factor zoo, that there had been 500 factors published in an almost exponential curve of academic research publishing over the years. And factors kept getting published, and then they'd be arbitraged away. The key point about these big buckets of quality, value, momentum, volatility, and size is they are and the market as a whole, actually, don't forget, that is a factor too. It's called the market beta. But these have been shown to be the most persistent and pervasive factors, and they have survived over long periods of time. There is more of a question mark over the size anomaly. It disappeared for a good 10, 20 years. But smart people can still, but there's been research showing that actually if you use size is still a very good factor, especially amongst if you control for quality. So, and I think that's a very important point. So I don't think these are going to be arbitraged away. I think certainly there's a risk that more and more of the market becomes more systematic. But what you've got to remember is that funds are under huge pressure to drop their costs. And I think what happens is that whenever a fund manager has any success in the market, they instantly are pushed to raise more money. So somebody has great performance, suddenly they advertise the performance and they raise more money. And that means they move out of the pool. Many opportunities become too illiquid for them. And one of the great benefits for individual investors is that we are much more nimble and have much smaller portfolio sizes. If you're lucky enough to have $1 billion in your pocket, it's often a lot harder to actually access these factors. And what you find in all the smart beta ETFs and the factor investing products, they tend to be what we call market cap weighted, which means they have far higher weightings towards the largest companies in the market, rather than higher weightings towards the companies which might be cheapest or best quality or best momentum. And I think this is one of the reasons why we've had such strong results in the market, is that they are far less tradable for institutions. So I think as a private investor, there's a lot of time until the market gets super efficient. I think there are risks from AI. There's risks from just the fact that we're doing this. And popularizing these methods. So I think there is a risk that the returns to quality, value, momentum will decline over time. But I think there's also been a lot of research which shows that they are expected to persist. So, I mean, like I said, if you look around the world, and I've tried to be transparent, they don't work everywhere all the time. And Joel Greenblatt, in his great book, the little book that beats the market, he said one of the reasons they do work is they all go through these bad times periods. Quality and value doesn't work all the time. It goes through 2 or even 3 year periods where it might not work. Everyone gives up on it. They go somewhere else. And then cheap stocks get too cheap. And then when they get too cheap, it works again. So, but one of the ways to minimize that risk of underperformance is to use these multi-factor methods. So, and I'll be talking more about this in my book when I get through it. Okay, guys, I'm going to cut it there. I think that's 2 hours and it's absolutely ample. I'm amazed that I've managed to keep your attention so long. Thank you very, 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 very much for listening. I really hope this has been useful. We will put it on the web. And I just really thrilled to be part of such a great community. And, I just wanted to say that to everybody, because everyone is a subscriber on this call. And I just want to thank you all for your trust in us and for sticking with us as we develop on these ideas. I can only say that we're investing more and more and more in the business. And there are huge, wonderful things to come. We are building all kinds of great things behind the scenes that will take a little time to percolate through into features. But when they do, they are going to be quite transformative. And I hope that you'll enjoy them as much as I've enjoyed building building them and working with the team on them. So thanks very much. And okay, I'll leave you to it. And I would just say, good luck, be safe. Markets are unpredictable. Future's not like the past, and always remember that. So be safe. Thanks a lot. Take care.